Hi, and welcome to Janken's Guide on Risk, the YouTube channel dedicated to the theory and practice of risk management. In this video, I will show how to implement a statistical exposure model using data on a real-world company. This is the statistical approach to quantifying exposures is a versatile and insightful method for generating exposure information, which is an essential part of a risk management process. So for more on exposure models, please consult my book, Corporate Foreign Exchange Risk Management, co-authored with Alfa Vinjesen and Lars Uxelheim. There's also more information on my webpage, riskbudgeting.se, and as they say here on YouTube, please like and subscribe. All right, so the statistical approach to quantifying exposures, we've introduced that in other videos. So it's essentially about using multiple regression analysis to quantify exposures. So we explore data on performance and data on risk factors to establish a relationship between these two and use that to quantify exposures. So we're going to assume that the relationship between risk factors and corporate performance as it appears in the historical data is a reasonable and valid estimate of exposures going forward. So it's about generating insights from historical data. All right, so approaching, exposure quantification this way is it's quite economical compared to the alternative, right? The bottom-up method where you can have a potentially very large and costly process for generating exposure estimates from involving all your business units and so forth. So that can be a real cost to that. You very often find that the exposure information that you get through this process is unreliable and flawed to the point where you might not even want to use it. And this is where the statistical approach offers an alternative that you can generate very insightful, good insights about exposures without this costly process. You can just use data to get a very similar kind of information, except more economical and very insightful. There's also the massive complexity in corporate groups that is a frequent reason why these bottom-up methods fail, whereas the statistical approach to quantifying exposure is insensitive to that. It's not bothered by the real-world complexity. It will just establish an average linear relationship between corporate performance and risk factors. All right. So conceptually, we're dealing with a model of this sort, right, where you relate corporate performance. This is the dependent variable in our model. We're going to try to explain and predict corporate performance here using data on risk factors like commodity prices, exchange rate, a large number of potential variables that we suspect drive corporate performance. So we're going to investigate that through the use of a multiple regression analysis. So these coefficients here will tell us the extent to which corporate performance changes as a result of a change in the risk factor. All right, that's a general idea. So let's look at how we can implement this, how we can work with this in practice, and see what kind of issues we run into and how we can resolve that and have progress and end up with a set of exposure coefficients that can inform risk management strategies. All right, so the case company is Equinor, a Norwegian-based energy company. So with a significant international presence, they develop oil and gas fields, but also increasingly wind and solar energy. So it's one of the giants in the industry. They have some 20,000 employees. So that's the background. So to implement the statistical approach, we need data, right? So the first order of business is to find some data on corporate performance that we can use. So here I've lined up corporate performance variables here, starting with revenue, cost of goods sold, gross profit, and so on. And this is straight from what you would find if you were to look in their financial reports. It's this data arranged in these series, ranging from starts here in 2005 Q1 and the last observation is 2019 third quarter. So we have the complete set of data for lots of corporate performance variables here for that period. And then we do a similar thing for risk factors. We go to some database and retrieve series for a matching sample period here. And we collect data on variables then that we suspect have a major influence on corporate performance based on some kind of analysis of the business model. I mean, we have to go first and think about how this value chain operates, what's their business model, what does the industry look like, what are the competitors. The whole setting here informs us about what are likely risk factors in the sense that they drive performance and introduce variability in corporate performance. So we've come up with the oil price here, natural gas, the Norwegian krona versus the dollar, the euro versus dollar, some interest rates, maybe inflation can have a role in explaining performance. So we're going to have a look at that and see. It's an empirical question, right? Which of these are going to be relevant? Not all of them are. We have a suspicion, but we're not quite sure. So we'll we'll let the data speak, so to speak. And we're also going to use some quarterly dummies. Quarterly dummies have the feature that they signal a 1 or flag a 1 whenever that is the relevant quarter. So Q1 here is quarter 1. So it flags a 1 whenever we're in quarter 1 in each of the years, right? So same thing for the second quarter. So it's just zeros and ones. And we can use that to capture seasonal patterns in the data. And before we run off to do regressions, we have to first check what the data looks like, how it behaves over time and that sort of thing, and inspect it. That's where this kind of analysis starts. And we're very frequently, with corporate performance variables and market risks, market prices, etc., we find that they are trending over time. You see it here in revenue, that starting out fairly low, there's an increasing drift. It drifts upwards over time. So what this means is that it doesn't have a stable mean. I mean, if the mean is somewhere here, it's consistently below that in the first half of the sample period and consistently above it later on. So, and this is a problem from the point of view of statistics, because many of the methods that we employ, they kind of presume a stable mean. I mean, the things like standard deviation and multiple regression are built on the assumption of a stable mean, so that you analyze variability around that. But when the mean is not constant over time, well, you can get nonsensical results. I mean, essentially, if you take one trending variable going up and you have another trending variable going up, they will always explain each other very nicely, but it could be completely nonsensical. It's just sufficient if they are trending. So we have to transform it. Whenever we find such a trending variable, I mean, in general, we just transform it always, as I'm going to describe here. So whenever you see a trending variable, it means that the mean is unstable. We can get a more stable mean by using changing. That is the first difference in the terminology. So we simply compute the change in the variable between two successive quarters. So we've done that here. So this is a change, the difference in revenue now. And it may not be the prettiest series in the world either, but at least the mean is much more stable. You can discern a somewhat stable mean here. And that's an improvement here now. Then the statistical tools that we're using, they work much better. They can be, the outputs will be much more reliable. So this is a data transformation that we start with. All right, so yeah, and to implement that in your econometrics program, you just basically compute that change, and the difference here between these two quarters is 637. So you will see that appear here. So we create a new series basically. This is a new series for the difference in revenue, right? So that's a new variable that we can use in the regression. Very simple. And I'm using Stata, by the way. It's an econometrics package. You can use whichever you prefer. Excel even, it's available there, this kind of functionality. So don't let that stop you. All right, so having run a regression now, just a single regression on the oil price on gross income. We're beginning to see some results here already. Note the change operator here. We're looking at changes in gross income as a function of changes in the oil price. And based on our prior understanding of this company, we might expect a positive coefficient here, that this company benefits from increases in the oil price. So we would expect a statistically very significant number here and a positive one at that. So we're quite surprised to find that it's actually negative and not significant. So here we have a puzzle on our hands. Why is this model returning an insignificant number with the wrong sign? So, but here again, some more knowledge about the business will clarify this for us. It turns out that the way this company's main product, the oil output here, is priced, there's a mechanism involved whereby the pricing occurs with a lag, so that the oil price in this quarter will have an effect on corporate performance in the next because of these contracts involved, how you write these contracts. So if we know this, we can, see if we can introduce that feature to the model and get a more, a result that agrees more with our intuition. But before moving on, let's make a note here that the p-value, we want it to be close to 0. That indicates statistical significance. We want it to be below 0.1 for sure, but preferably even below 0.05, because that's, when the significance gets scientifically sort of supported, but at least 0.1 is the goal here. So this indicates non-significance. It's not low enough. But all right, so let's lag it then. If that's the problem here, that we need to capture, we need to find a way to capture the fact that the oil price operates on Equinor's performance with a lag. So we do that in the model here, sorry, in the statistics package here. We just lag the variable. This is a lagged oil price. So the price that really occurred in the first quarter here will now be appearing in the second quarter. That means we lag it 1 quarter. And that's on a new series as well that we can incorporate into our multiple regression. So let's try again here now. Notice that we're now lagging the oil price. T-1 means a lag 1 period. So the previous quarter's oil price is used to explain the current quarter for corporate performance. So now this lagging is incorporated into the model. We can deal with that. And now there's some stars here indicating statistical significance and the right sign. So that turned out to be, what we needed to get the model to come to census. And just took some knowledge about the business model. So moving on, we can add risk factors to the model. But all right, quarterly dummies are not risk factors, strictly speaking. But we're going to look to see what happens when we introduce them to the model. They capture the fact that across the year, volumes and output are not constant for a company like Equinor, and it's for most firms they see some seasonal variability, right? Most firms see a jump around Christmas in sales and that sort of thing, and energy consumption presumably higher during the cold winter months, right? So that sort of thing will have a role here in explaining corporate performance. And indeed, for these 2 quarters, there is a negative effect. If you look at quarter 2, it's a fairly large negative impact from that in that quarter, and a fairly large one in Q3 as well, the summer months, indicating that the winter months are you see more output then, presumably. I mean, that's when the demand for energy is higher. So something like that could explain this pattern. I mean, you don't see Q4 in the model because that's the base here. So all these quarterly effects, these coefficients here are relative to the 4th quarter. That's the base quarter in the model. So relative to the 4th quarter, there's a negative impact in the 3rd quarter. Now, the oil price is very significant, 3 stars now. So this is beginning to look like an improvement, right? It makes sense to have some quarterly effects in the model most likely. So all right, let's take that and move on. I'm going to suppress the quarterly dummies now. I mean, they make things look more complex than they really are. So they're not shown here, but they're part of the model. So let's change to EBIT now. That's more of a bottom line, further down in the net income statement, and we're still looking at changes and still using the lagged oil price. But it's a different measure of corporate performance that may be of even more interest to us. So here we find another puzzle. Now the oil price turns out to be not significant. So why is that? I mean, we would still expect it to contribute in a major way to corporate performance, right? Well, again, we have to know the data and understand where they come from and what they consist of. And in this case, impairments are creating some noise in EBIT, and we have to do something about that. Look here, this is historical data on impairments, and in the fourth quarter 2016, there was a major impairment of some of the company's oil and gas assets, leading to a loss on the operating profit level in that quarter. But it was completely driven by this impairment, which is a one-off thing. You write down your assets. So they took that hit in that quarter, and this messes up the model essentially. This is noise from the point of view of the model. So let's back that out. Let's reverse impairments from the model, so as if they didn't happen, or if we exclude it basically. So we get EBIT adjusted, which doesn't contain this impairment effect then. In addition, there could be a link between impairments and the oil price, right? So that confuses the model even more, because maybe you have to write down your assets when oil prices aren't sufficiently high in relation to the cost base, right? So this is giving the model a chance to estimate the marginal effect of the oil price in a better way. So yeah, these are the variables, and that's the problematic quarter, and we can just reverse that and have an improved estimate of performance. So another thing to consider here at this point is that, well, the dollar, the oil price for sure should be in the model. That makes a ton of sense, but also the dollar, right, versus the Norwegian krona, because you're selling oil into the market and generating dollars as you do that. But this is a Norwegian company, and they will convert that to Norwegian krona at some point. So with that logic would lead us to consider including the dollar versus NOK exchange rate, the Norwegian krona here. So to capture that transaction exposure. So now we have EBIT adjusted instead, corrected for impairments. We're using the oil price lag one period as before, but now we also have the Norwegian krona in the model. So we would expect a beneficial effect, a positive coefficient here from changes in the dollar. When that strengthens, that should be beneficial to performance. And indeed, we'll get this. The oil price is now significant also, and positive, as we would expect it to be. Super strong or very strong significance here in the dollar versus Norwegian krona with the expected sign. This is a model that makes a lot of sense from an economic point of view, and it has statistical support here. So this is something we could consider, using for, devising risk management strategies and informing ourselves about how this company's performance is moved around by some of the more important risk factors. So, but looking at these coefficients, the magnitude is vastly different, right? So you may wonder, well, what goes here? What do we make of that? Is the dollar versus NOK that much more important? No, that's not really what we're saying, because the units, the scale is different here. This is measured in dollars. So one change in the price of oil means it goes up $1. Whereas here, one unit change in the dollar versus NOK means that it goes from, let's say, 8 to 9. Or 7 to 8. That's a much larger change in percentage terms, right? So it doesn't really mean that it's a different scale. So we can't compare. If you want to compare, you would run a model in percentage terms instead. You have an elasticity now when you look at the percentage change in revenue as a function of percentage changes in oil and the exchange rate. Now they will be more comparable, but a lot of times these models suffer from extreme values as corporate performance often goes towards zero, and you get fairly extreme values when it jumps from, let's say, 5 in one quarter to 200 in the next. That's a massive percentage change, and the model, that's takes you outside the sort of assumptions that are required to be able to defend this approach, right? So for that reason, we don't always find ourselves in a position where we can do that. But just know that this method can be used to make these marginal effects more comparable. So if we do that for revenue here, which is here the percentage changes are more stable. So then this approach works well to take percentage changes and estimate elasticity. So we see here that the oil price has a larger coefficient. So for a 10% change in the oil price, there's a 7% change in revenue, whereas the same 10% change in the exchange rate leads to a 3% change in revenue. So that indicates the economic significance better than the other coefficients in this model. So yeah. Other considerations here. Well, we didn't find, not shown here, but there was no significance on the natural gas price variable, presumably because it's highly correlated with the oil price. It's trying to express the same kind of information. So it's actually sufficient from an econometric statistical point of view to have the oil price in the model. It will capture the effects of the natural gas as well, because they're tightly linked to each other. So these exposure models work like that in many cases, that you only need one variable to capture the impact of a group of correlated variables. We didn't find any effect on interest rates either. EBIT is before interest expense, first of all, so that's sort of expected in that sense. But it should be said that commercial exposure to interest rates exists for many companies. If the interest rate goes down, that can have a beneficial effect on companies that they rely on customers by being able to buy on credit. So the cost of that credit will be lower when the interest rate go down, and that has a beneficial impact on demand. So there can be such commercial effects from variables like interest rates, but not so for this company because it's crowded out by the oil price and the exchange rate because they're so dominant in explaining performance. All right, so summing up, the statistical exposure model works best in changes. That's important to remember to deal with these trending variables and all the problems that are created by that. As we do this, you could consider seasonal effects. A lot of companies have those. Sometimes relationships are lagged, so we should be open to introduce a lag into the model and see if that improves. There's also an issue with distorting noise in performance measures that you might want to adjust them first and clean them up and have a more representative measure of underlying performance. It was impairment in this case that tripped us up a little bit. So when you do this, you have a model at the end that informs us about the sensitivity of corporate performance to changes in risk factors. We have the sensitivities that we wanted that we can use as part of risk management. So this is highly useful information, and we were able to get it through this model. All right, so that concludes, and please read more in my books, Corporate Foreign Exchange Risk Management and Empower Risk Management, and check out my website riskbudgeting.se, and please like and subscribe. Have a good day.